Hello folks, Charlie Gipple here with CG Financial Group. As promised, wanted to talk a little bit about the inverted yield curve that happened on Friday. This is important stuff. Why? Because every recession for the last 60 years has been preceded by an inverted yield curve. So this is important stuff. This is not just me doing mental gymnastics on video for the fun of it. This is important. Now, by the way, I'm not prognosticating a recession. I'm not prognosticating anything. I'm just reporting, and I'll let you decide. However, I will say this, that the stock market is over 10 years, as of March 9th actually, 10 years in to a bull market that usually lasts 48 months. But I digress. So in order to talk about the inverted yield curve, what is a yield curve? What's the behavior in the marketplace that causes a yield curve to invert? Before I go there, I wanted to set kind of some framework, level set some, throw out a refresher when it comes to the foundation of the bond market here. So there's a teeter-totter in the bond market, and that is the price versus interest rate relationship, right? When interest rates increase, the prices on bonds currently out there in the marketplace decrease. When interest rates decrease, the price of bonds increase. Why is that? I was on the phone explaining this to a customer a couple years ago, and my wife says, so you mean to tell me that when interest rates increase, should they ever increase? And Charlie, we're in a low interest rate environment, right? I said, yeah. She said, so you mean to tell me that when interest rates increase, on this safe investment that we have called bonds and bond mutual funds, that we could actually lose money? I said, yeah. She goes, why is that? I said, well, because of the inverse relationship. She says, yes, I get the inverse relationship, but that makes no sense. Why is there an inverse relationship? I thought, you know what? I should know how to explain that in a simple, succinct fashion. But I don't. So I winged it. And I did pretty good, if I say so myself. I said, okay, Noelle. Noelle is my wife's name. I said, so Noelle, here's the deal. Let's say you have two different types of bonds. You have U bonds. This is the bond that you currently own. Say you bought it 5 years ago. You have new bonds as well. These are the new bonds being issued by the same company, same entity, whatever. Let's say the United States government. So the U bonds guaranteed you $5,000 per year in interest. Bonds usually pay a semi-annual interest payment, right? If you put in $100,000 and you have a coupon of 5%, it's going to pay you semi-annually $2,500. That's a coupon of 5% or $5,000. But I digress. Let's say that bond that you own, Noelle, as of 5 years ago, is paying you $5,000. And it's still paying you to this day. Why? Because it's a 10-year treasury bond. Let's say that today, that 10-year treasury bond, and by the way, these interest rates are purely hypothetical. It's not the government, obviously. That's too high of an interest rate, but you get what I'm saying. The new bonds today, let's say that because interest rates decrease, that new bonds today are paying new investors $3,000. The interest rate environment is decreased, right? Well, with your bond paying $5,000, new bonds paying $3,000, what does that do to the mindset of investors out there when they think of your bond versus the new bonds? That's pretty darn good, right? And as a result, what's going to happen to the demand of your bonds, to the U bonds? It's going to increase. When demand increases for your bond, what happens to the price of your bond? It increases. This is the environment that we've been in since 1981, September 1981, when the 10-year treasury was yielding 15.84%. It's declined steadily and persistently, right? We've been in a 38-year bond bull market. By the way, I at CG Financial Group have a piece on this that you can share with your clients. Now, what happens if the inverse of this happens? Let's say that the U bonds that you owe are paying only $3,000, but the new bonds now, issued 5 years later, for instance, are now paying $5,000. What does that do to supply and demand dynamics of your bond? You can bet that the demand for your bond, at least relative to these new bonds, is not going to be as high, which means because interest rates have increased, the price of your bonds have decreased. That's the supply and demand dynamic that's out there. And there's this equilibrium of supply and demand and interest rates that keeps everything in line. Going to talk a little bit more about the equilibrium as we move on to what is a yield curve. What is a yield curve? A yield curve is, I already drew this out because it would have been boring for you to watch me draw two yield curves. So these are two yield curves. This yield curve, which looks actually quite normal, is from late 2016. This yield curve that happened on Friday, well, that's from Friday, right? Let's talk about this yield curve first. So what indirectly controls the short side of the yield curve? Look at that. That's a huge difference, right? There's a 2% or so difference between 2016 and this. What indirectly controls this side of the yield curve there? Monetary policy, Federal Reserve policy. So when the federal funds rate increases or decreases, that sets off a cascade of market forces that basically bring that side of the yield curve pretty close to in line with what the federal funds rate is, right? And as you can see here, over the last couple year period of time, 2.5 or so year period of time, the Federal Reserve, as we know, has increased rates quite a few times. I forget the number since December 2016, this yield curve, but they've increased it quite a few times. So the Federal Reserve indirectly controls this side of the yield curve. But a healthy yield curve is increasing, kind of like that. Why is that? Because let's go down a notch on the yield curve. Let's go down a little longer on the yield curve. Let's go to the 3-month. Why does the 3-month usually always pay more interest than the 1-month? It's a lot like a mortgage, right? If you take out a 15-year mortgage, you're going to pay the bank less than what you would a 30-year mortgage. Why? Because 3 months has more liquidity risk to the investor, right? 3 months has more default risk. Granted, we're talking about the United States government here, but you get my point here. Or let's exaggerate, the 1 month versus a 30-year. Let's say this is a corporation, the yield curve for a corporation. The corporation paying you back over a 1 month period of time is a heck of a lot more guaranteed than that corporation being in business and paying you back 30 years from now, right? So therefore, investors always demand, almost always demand more interest rate on the long side of the yield curve than the short side of the yield curve. Why? Because you have that liquidity risk, you have that default risk. And typically what would happen is, let's say that things got out of whack, right? Let's say that the 6-month, for some reason, the yield started to go down to where it was less than the 1 month. Well, that's not very attractive. You have a 6-month bond, or a 6-month bill, I guess you'd call it. Shorter term ones are bills. You have a 6-month bill that is paying a yield that is less than that. Well, the demand for that would not be very high, right? But remember the inverse relationship, because the demand is low now on the 6-month, which is only paying 0.01%, let's say. What does that do to the yield? What does it do to the price? It decreases the price, which means, remember that inverse relationship? The yield would then increase. That is that equilibrium that I'm talking about there. Anytime that gets out of whack, there is usually an equilibrium that brings it back into line with that nice, smooth, steady slope in the yield curve. However, you're thinking, but that didn't happen on Friday, and you're absolutely right. What in the world would cause, say, the 3-month Treasury bill to yield more than the 10-year Treasury bond, which is what happened on Friday? This is the definition of an inverted yield curve, to where the slope is going the other way, i.e. the inversion relative to what it normally should be. The reasoning is this, right? Demand for the 10-year Treasury bond relative is really high, right? Why? Because the demand is high, prices for 10-year Treasuries are high, which means the yield on the 10-year Treasury was compressed. I don't remember what it was on Friday. Was it like 2.45%? But the yield dropped. And by the way, anytime you see the stock market absolutely crash, what you're always going to find is, almost always, is a 10-year Treasury yield is going to come down. Why? Because people leave the stock market. They go over into the 10-year Treasury, which is a safe haven. That drives the price of the 10-year Treasury up, but that yield, it drops from 2.6 to 2.45 or 2.4, whatever it is. That is what happened on Friday. And by the way, on Friday, the market did lose like 460 points, right? Why? Because, I won't talk about the stock market, but this dynamic happens when 10-year Treasuries have a high demand relative to what it was previously, which basically that means, well, Okay, so if I go into the 3-month treasury here, what happens at the end of that 3-month period of time? There's reinvestment risk, right? And if people anticipate that after 3 months or 6 months, in the short term, that after that period of time, well, where am I to reinvest my money? And the chances are is the Fed is going to have decreased interest rates again, and I'm paraphrasing, being a little facetious here, decreased interest rates again. Why? Because the economy is not that good at that point in time, and therefore I'm going to go into the long term. In other words, skip over all of this that happens between point A and B and just be locked into a long-term safe haven. That's where I need to go. That is why the 10-year Treasury has more demand today, which was Friday, than what it does relative to history, relative to the 3-month Treasury bill. That's the kind of psychology that people say causes an inverted yield curve, is basically what happens after the 3-month period of time. If it is kind of a dire situation, there are dire expectations of what's going to happen 3 months in, 1 year in, 2 year in, 3 years in, then that is when the demand for the 10-year Treasury, in this case, goes up, which causes the yield to go down to where the yield, a weird phenomenon, right, is actually less than what investors are accepting on the short end of the yield curve. It's not an easy topic to talk about, but basically, in short, if I were to sum it up into about a 10-second soundbite, the reason the demand on this side of the yield curve is relatively high to cause an inverted yield curve relative to this side, it's because investors on Friday said, let's skip what happens everything between now and 10 years from now, because maybe the crap's going to hit the fan, I don't know, and then we'll see you again 10 years from now after I get out of my safe haven at that point in time. So that's the inverted yield curve. Again, I'm not prognosticating anything. I do believe we are in a new normal because, as many of us know, the United States government has purchased a lot of these types of bonds, right? QE1, QE2, QE3. What happens when a checkbook the size of the United States government, what? I have the ability to $4 trillion a year in expenditures. That's a big checkbook, right? When they start buying their own bonds, that compresses the yields. Why? Because the demand of the United States government has a lot of power. The price goes up, which means that the yield on the bonds on that long end decrease. So suppressing interest rates has been the mission of the Federal Reserve for many years, and that, in fact, has kind of worked, right? So maybe we are in a new normal. I'm not prognosticating anything, but I hope that clarified the yield curve. It's not an easy conversation, but I hope you got 1 or 2 things out of this. Feel free to contact me at CG Financial Group if you have any needs, need any more information on this. I do have a piece on this as well, so feel free to call me or email me. Thank you for your time.